Hi, I'm Tom Dorsey. I thought I would do the Dorsey Right Minute today. We were going to kind of hold off until we had less chatter in the room, but there's nothing you can do. I mean, this is live. It is what it is. One of the things I wanted to talk about, most investors really have no idea that there are two different Standard & Poor's 500 indexes. Each one have the exact same 500 stocks, and you would be surprised at the difference in performance. If I looked up here and I said, okay, let's look at last year's performance in 2009, you'd be amazed at the difference in what took place. The equal weighted Standard & Poor's was up 43%. The capitalization weighted Standard & Poor's was up 23%. Now, what does that mean? If you think about the two houses of Congress, the Congress and the Senate, the Congress, the larger the state, like New York and California, have more congressmen. So you would say that was capitalization weighted. The larger the stock, the larger the capitalization, the more votes the capitalization weighted Standard & Poor's index has. Then there's the equal weighted. It's more like the Senate. Every state gets 2 senators. Every stock in the equal weighted Standard & Poor's 500 has the same vote. So the smallest stock in the S&P 500 in the equal weighted index has just as much say as the top stock that might be General Electric or Exxon or IBM. So the two trade totally differently, even though they have the exact same stocks in them. Had you known last year that the relative strength charts, when you compare one thing to another, as we do, we divide one thing by another, we get a number, we plot that on a point and figure chart, and it suggested to us early on last year that the real place to be was the equal weighted Standard & Poor's index. The difference would have been 100% difference in performance in the equal weighted versus the capitalization weighted index. You have to understand this, and I almost call this the people's portfolio. If you, on our system, and you utilize our smart chart system, you have the ability to compare and contrast one thing with another. You can effectively manage the market just with the Standard & Poor's 500 and money market by knowing which Standard & Poor's 500 to be in, and then compare that with money market. If money market overtakes that particular index itself, you should be in cash. And sometimes cash is an asset class. Sometimes you should be in equities. But which equity should you be in? It can be as simple as knowing which asset class to be involved in, and then the exchange traded fund products allow you to step into that universe with as little as buying one share of stock. So that's the Dorsey Right Minute. We'll catch you tomorrow.